Hi, everyone. I'm Bayo, founder, CEO for Dr. BDZ Capital. And I have my partner here, Dr. Ozoude, George. He is a founder and CEO for Time Health Capital. We met about a year and a half ago. And since that time, we found a good synergy. And we're exactly the same people with different kind of interests that converged. And, he's full of energy. We're like, people ask us all the time, how do you get so much done? But, those are the kind of people I like to partner with. And it's been very fruitful so far. So with these webinars, we've been, inviting other people, usually, and we decided to start the year with just the two of us, kind of giving you an idea of how we get here and also how we came to make the decision that we make in terms of our investment choices. So I'm very happy to be sharing this presentation with everyone tonight. So we'll be discussing personal financial goals and how real asset investments can help you meet those objectives. Of course, we have to do the disclaimer. We're not personal, we're not your legal advisor, and we don't provide tax advice. So please consult with your licensed professional as needed. This content is mainly informative. Our goal today will be to introduce ourselves and our goals. Like I said, we're going to describe our financial objective of investing, and then we'll describe some asset classes that we've been doing that meet those investing objectives. So I'll start with myself, and then I'm going to punt it to George after that. So my background, of course, pulmonary critical care physician, and over the past 5 to 6 years, I've started my journey in real estate investing and also some venture capital on the side. My real focus was, which is both of our focus, helping other physicians achieve financial freedom through real asset investing. I'm a real estate operator. Operator word is usually used to define people that actually runs the asset. They actually do the operations. So we have sponsors, we have partners, but I actually do like operating. I like to own assets, and I actually like the fun of changing the structure of the buildings, kind of the creativeness that is involved. I love it. And I also partner with best-in-class operators with real asset investments. If I don't have the deal of my own, and I know an operator that have a very good and awesome deal, yes, we do partner also. So this is my portfolio so far. From 2018, started in Canada. I'm from Canada, and I grew up in Canada. I'm from Nigeria, then went to undergraduate in Canada. And even though I lived in the US at the time, I knew the market more in Toronto. So we do these reassignment homes, which we put 10% down, and for new construction, single family homes. And by the time they finish the construction a year or two later, it has appreciated, and you can reassign it to someone else and then take the profit. So, it's been doing great until the recent crash. So, but, so I love it. But obviously, those are just like single family homes. So I started moving to multifamily in 2019. 2018, I was also involved in some construction, which we're still in the process of completing in Toronto. Scarborough, Ontario. It's about 15 minutes to Toronto, and it's a big market, lot of hurdles, and I learned a lot very quickly. that I can not undo multifamily construction on my own. So, then you need a team. And so that's where we are. So then I started with buying multifamily properties. So now, personally, my wife and I has about 62 units now in multifamily units of our own, and I do enjoy operating that on the side. And at the same time, I've done, luxury senior living. Two of them is under construction. We've done at least 5 storages so far, including both storages. We've done office, oil and gas deal. We had fund 1 completed. We're about to start the fund 2. Actually, we started in December. We have another 376 units, multifamily, closed phase 1 and phase 2. We're on to the phase 3. And then we have another 129 units under contract currently. George and I, we're going to be doing some webinars soon with our acquisition manager once we make sure we secure everything completely, So, that's my story. And, just, get you to understand where we're coming from. I'm going to give it to George to kind of explain, his side of the story.
Awesome. Thank you, Bayo. As he mentioned before, I'm the founder and CEO of Time Health Capital. It's a private equity investment company that focuses on also financial freedom for physicians through real asset investing. I function as a syndicator, so we partner directly with best-in-class operators like Bayo in order to leverage those trusted relationships and acquire real asset investments for our investors. So my investing experience is spread across active co-sponsoring, passive investing in syndications, and personally operating my own short-term rental. On the passive side, I've invested into a mix of over 20 different deals and counting, starting with a surgery center in 2016, and then expanding into residential apartment buildings, farmland, and mineral rights deals. I've invested over 1.3 million of earned capital to date into these deals. And this includes 2 large residential funds, development funds, and in total about the amounts to about 4,000 doors in all. So my why, our why of doing this all stems from some of the core values in our lives, starting with the 2 most important forms of wealth in anyone's life, which is their wealth of time and their health. We believe these are the foundations of personal freedom and impact the ability to realize other forms of wealth, as we shall see later. As a practicing orthopedic surgeon and Bayo as a practicing critical care pulmonologist, we also value control over our careers and how we deliver care to our patients in the form of our autonomy. And I see investing and financial freedom as the means to an end with these values in mind. So a quick word about the concept of wealth as it relates to financial freedom. Wealth can be measured in many different ways. There can also be a wealth of knowledge, of relationships, of social capital. And we all know wealth can be measured with monetary capital as well. But I would emphasize that money as capital is really only a tool that can be used to realize the other more important forms of wealth. And so financial freedom is the result of effectively using your money as a tool. So your tools help you work on the overall objectives that will lead to financial freedom. These objectives may be different for each person and must be defined in order to define specific financial objectives. For some, it may be to replace their income from their job. For others, it may be to improve their standard of living. And for many of us, it's to secure our retirements in our retirement years. So increase of capital, health, and well-being with specific financial objectives is the goal. So finally, we get to those financial objectives of investing your monetary capital, which can be varied based on individual circumstances, as mentioned before. But basically, one can hope to obtain capital appreciation meaning growth of your net worth, but there's also capital preservation to protect what you've already earned. And in the current economic landscape, many look to protect their purchasing power as a subset of capital preservation against the rising inflation and wealth destruction. Then we have cash flow, which is very popular because this is increased regular monetary income, passive income that comes through your investments. An objective of many high income bracket earners, such as physicians and busy professionals, is to lower their earned tax income burden. So that these are all like financial objectives that we identify and define. But they can further be broken down based on risk tolerance. So higher risk can be taken on in an investment to yield more aggressive returns for any of the aforementioned objectives. Aggressive average cash flow can mean over 15% yearly, or aggressive annual appreciation can mean 50 to 100% averaged over a year. And on the conservative side, you can have cash flow between 6 and 10%, and appreciation of 15 to 20% annually. One's objectives can also be to make their profits return with a very fast turnaround time, such as in short-term holding periods, which are usually months to a couple of years. And on the opposite side of that, you can have investment objectives that may have returns come in regularly over long periods of time, such as years to even decades to even lifelong legacy assets that you hold and pass down. So there are additional non-financial objectives, as just mentioned, that one can consider when investing. Some people want to invest in order to pass down legacy assets to their family and their loved ones. Others may look to establish or be a part of a like-minded community of investors. And interestingly, some goals include to establish a connection or a familiarity or residency in international locations for retirees. And then finally, some may have personal philosophical reasons for investing, such as minimizing counterparty risk, de-risking exposure to more volatile markets, especially in these current times, or just in support of agendas in technology, environment, society, or government. So once those financial objectives are defined, then you can shift over to the specific real asset classes, and they can be analyzed for their investment return profile. Here we have listed just some, it's not a comprehensive list, but it's a few examples. So I'm invested in several of these. Bio has his own set that he's invested in. Keep in mind, some of these asset classes have subsets as mentioned. So there's single family, and then you have subsets of that where, you can be in a long-term rental or a short-term rental, or you can do fix and flip, which Bio will talk about. There's also medical office, which I said I started with. There's agriculture, which I'm invested in on an international scale. There's commodities and precious metals. And I think Bio has some other ones that he's invested in. Which ones have you been in, Bio?
I mean, mainly oil and gas, really.
Yeah. And additional, yeah. And some senior living and.
Yeah, so I've done storages, oil and gas, multifamily, as a single family with the reassignment deals, medical offices in general, luxury senior living. We have two of those. Yep. I also do personal lending. Yep. I kind of, do that, once in a while, somebody cannot close a deal. They need like 100K, 200K if I have it, and so everyone has its own advantage and disadvantages. So. Right.
Which we'll go into now. So single family is the common investment because it's a relatively low barrier to entry for most people. You can hold these with long-term renters and generate capital appreciation and usually a more conservative cash flow profile. While short-term rental properties have a little bit more of an aggressive cash flow profile. And there's also a loophole for earned income tax shelter, including W-2. So that's a special feature. There are rare or not a lot of W-2 tax options for real estate investors. So this is one of them. And then Bio has done some wholesale and fix and flip, right?
Yes. So, wholesale, very short-term appreciation. It's, very labor intensive is one thing I'm going to say. Even though I have a contractor and we have, we have a project manager, we have contractors, but somehow, almost every few hours, you're still going to have some decision to make because it's very fast. You're trying to flip this within like 2 months or 3 months. So, it's, the speed at which it occurs, but it's very, lot of cash, injection as a result, I say through the appreciation. So the last one we did was we bought at 130, put in like 20K in it, and then we sold for like 230. So you could, double your money very quickly because how much you actually put in, it's only 20% plus the renovation cost. So, and then, you pay a percentage to your contractor. So, it has its own, you can potentially do that. And wholesale, I work with wholesalers. They put in property under contract. So let's say they find someone that, their life happens to them and they want to quickly sell their property. This property is worth 200K, but you're able to somehow get it for 150K. You can flip it very quickly to someone else for 170. So you can be like, okay, well, I got it for 150, I'm going to sell it to you for 170. And many people actually buy this, including me. I buy from wholesalers. You have to do your due diligence, obviously, because sometimes the paper trail, they're not wholesalers, they don't have the same fiduciary duty like a real estate agent. So you have to do some of your own work with wholesaling, but it could be productive. And also, development, we both done development deals, and most development deals are usually very good for long-term appreciation. The advantage is long-term appreciation and tax shelter. So because they're new, you can depreciate a lot of properties, a lot of, equipments, and, everything is new. HVAC is new, windows new, everything is new. So you could, you have a lot to depreciate. Most of the time you can depreciate out to maybe, I can use watercolor as an example. For every 100K, you get like 120 to 140, throughout the life of the term of the investment. So that's over 100%, that you can get, and that's because it's new. For many of our, regular ones that have been around for a while, you can get maybe 60, maybe 80, percent, depreciation from them. So, yeah.
So yeah, in general, you notice you won't see cash flow on one of the lists here for development because there's for 1 to 2 years there may not be any residents while it's being built. So this is definitely more of a appreciation and tax shelter strategy as opposed to some of these other types of properties that have tenants and are making cash flow and revenue. And I'm in short-term rentals, and my goal is I was a W-2 tax worker and I wanted some earned income tax relief. Cash flow is definitely higher, so I wanted to kind of get that. I'm a little bit more on the aggressive side because that's where I am in my investing season. I want to aggressively grow, but within reason. So looked at that, compared it to long-term, and felt like short-term is something I wanted to pursue. And then same thing with development. I wanted a little bit more of an aggressive appreciation. Everyone's a little different. Some of my portfolio is development where I don't worry about the cash flow because of a higher income stream from my job. But, as we'll see, there's other ways to invest where you can actually look for more cash flow with development, or with other properties. So with multifamily, as Bio was mentioning, there's more scale and therefore more predictability. So in light of that, there's still cash flow and appreciation, but it's on a more conservative basis because, for some developments for some acquisitions, you have large syndications for 75 units or more. This is where you have 60 to 100 investors that are passively investing. So this is a very common vehicle that you'll see presented many times is this large syndication for conservative cash flow, whereas Bio can speak on like the mid-size multifamily acquisitions where you can personally own the investment because of the lower barrier to entry, but this actually can lead to more aggressive cash flow because you're not splitting all those returns with more than 60 to 100 investors. It's just between maybe yourself or a small group of investors, 4 to 5, doing a joint venture. Bio, anything on that?
Yeah. Yes. So what I can say is, even with property manager, it's still it's not going to be under completely passive income. So it's going to be semi-passive, So you just have to look inward and decide for yourself what do you want, So I enjoy it. It's almost like I like the struggle, of actually trying to fix the property. We bought a 33 unit in Tulsa, and, it requires us to, pass the utilities to the tenant. So that will take some time to do it. It requires a little bit of fixing and also evicting people. So out of the 33 units, we already evicted about 9, and we already, got people back into it. So because you're doing a lot, right? Every time I have to make a decision, the property manager will send to me, are we changing to, window units to central AC? What are we doing with this and that? So it's definitely take more of your time, but the return is higher because we bought it for 2.2, and we already got some people putting offer, less than 6 months trying to buy it for like 2.7 the other day. So, you could get a better return because you have a little bit more control. It's small versus a bigger property like Watercolor. It's so big that you have enough teams in place that I don't have to do much work on that particular one, because, but then at the same time, as you're building that bigger team, you're also you're paying them. So the return is coming down slowly, but depending on how you look at it, it could be safer because everything is professionally done, Whereas in my 33 units in Tulsa, I could get my maintenance guy to do a few things. So you can save in cost. So, at the end, you just have to find what your objective is and what your time and what you're willing to do. But it's not wrong for you to try one time, just buy 4 units or 5 units and see what happens, if you like it or not.
See how you do. Or, you can kind of shift and pivot and just focus on being more passive. And even though it's more conservative cash flow, if you build up enough of these passive investments in large apartments, say like 40 to 50 over the course of your lifetime, this can get to such a high amount that maybe you have, $3+ million invested or $5 million invested, and the passive income that comes in, the conservative cash flow, is still enough on aggregate to even replace a physician income. So there's definitely folks out there with, 40, 50 different active current ongoing large investments. So it's still a very powerful tool, even though it's a more conservative return, if that makes sense.
I mean, you have 20, right?
I'm 20, and I'm, trying to get higher and higher. So, replacing the income is one of the goals for me. So that's my objective. I want to be able to replace my physician income and then decide if I want to do medicine at all or versus doing it in a different way. So that's exactly the point. Development is the same, very similar, aggressive appreciation compared, just like a single family. You're waiting on the development to finish, and then you'll have tenants and then either sell or cash flow at that point. And it also has good tax shelter. So then there's oil and gas. One can invest in drilling of oil and gas companies, which can be very attractive to physicians as it yields higher aggressive cash flows, talking 20, 15 plus 20 plus %. And there's substantial earned income tax shelter in your W-2. And again, this is one of the few ways a individual can shield their W-2 tax income from an investment. It's really good because it's recession resistant, similar to multifamily acquisitions. As energy as an asset, as a sector, is always going to be in demand. It will always remain high. Bayo can speak on self-storage. He's very familiar with that space.
Yeah. So we do self-storages, both storage. It has aggressive cash flow for sure, because especially if you're already like 90% occupied, it's already occupied and you don't have to do much. So that's why the less than 25% of your income from storage is used for operations, versus multifamily could be as high as 50%. We all know about the 50% rule. So you can automate the process, which you eliminate having a management team, and because of that, it's a very aggressive cash flow. It also recession resistant. I think it's probably number one in terms of recession resistance. It was very surprising that during COVID, out of all of our investments, the storage was the one that stood tall. Mainly, even when people leave, they couldn't afford their house and moved out, they go to apartments, and now they have to store their belongings. So, so that's it for self-storage. But the problem is appreciation is a little bit slightly lower overall, versus multifamily. With multifamily, you can force the appreciation much in a larger way. You can get, something rented for $500, but the market is $800. Fix it up quickly, and then increase your rent. You can, build a swimming pool, you can basically change the appeal, change the structure. There's lots to do, but with storage, there's not a lot to do rather than to improve the security system, make it safer, make it look nice, a little bit nicer, but there's not enough things around. Also, the depreciation is also lower. For storage, we're at about 40 to 50% on the higher end in terms of depreciation, because there's not a lot of things to depreciate. You just have this four wall, piece of metals, and gates. So that's where you can depreciate. You don't have a lot of things to depreciate.
Yep. And then with agriculture and farmland is also always in demand. We always need to have food. So these assets, there's assets like lumber and citrus farms. I'm actually invested in a citrus farm. But things to note about these asset classes, even though they're recession resistant, they do take longer to yield returns because they obviously have to get planted and grown and then start yielding the product. So I think of these in terms of kind of long-term investments, right? The cash flows and the returns can vary depending on, which actual farm or type of product is produced, but these can be legacy assets, right? They can be, 20, 25 years, of asset that you can pass down to your families and loved ones. So they can also, interestingly, be used as ways to establish familiarity and residency in international countries. So there's a lot of citizenship or visa programs or residency programs that you can get. And that might be a personal objective for many people, whether it's considering for retirement or for other philosophical reasons for having, access to these other countries. Retail and office have a similar profile to each other. These have very stable tenants, and thus with that stability, you have a little bit more of a conservative cash flow. So if you're, not as aggressive as an investor, you don't need aggressive cash flow, this might be a better option to fit your objective. And there's medical office. It's a very diverse group of sub-assets in that. You can have varying investment profiles. I'm particularly, as mentioned before, invested in a surgery center, and these investments can yield higher, more aggressive cash flows. And there's some moderate appreciation that you can get as well. It's a good option, especially, in this group, our community is a lot of physicians. So it's a good option for, passive investment as a physician, because you can be a provider in some of those medical office buildings and support the overall business, which you're invested in on the limited partner passive side. And then as a general partner, you can invest in these as well, but it's, definitely comes with one of the highest operational burdens and liabilities, because it's medical and there's a lot of expensive equipment, a lot of people to manage, and that cuts across medical office building as well as senior living, which Bio has invested in as well, right?
Yes. For senior living, it depends on how you do it. So Guarav, is one of my other partners from Majestic Investment Group. He runs a lot of luxury senior living. I think he has about 6 of them now. Some of them he even exited from. They cash flow a lot in terms of, by the time you have about 40% occupancy, you break even. And many of these, before you finish the construction, you're already at about 60% occupancy. So now if you're like 80, 90, that's a lot of cash flow. But the same thing is that a lot of operational burden and liability, not so much for the limited partner, but even on the side of the general partner. So we had a plan to have one in every state. So we kind of slow down on that now, knowing how tough it is in the luxury senior living space. I mean, it's good. The silver tsunami, lots of baby boomers are coming of age, and we're going to have trouble. We're going to have problem with where to house every one of these people. But it's a lot of operational burden. Like you're moving too many pieces, so you have to be ready for something that is, to me, very much difficult than us a multifamily, for sure.
Yep, agreed. And well, a lot of us here are physicians, so we appreciate that silver tsunami. We see that coming, and that's why that second point there is in there. That momentum. You can shift with the shifting times, and you can take advantage of what is coming. And so this is a momentum, potential momentum investment and strategy that you can use for senior living. So commodities, and I invest in mineral rights. And this may not be as familiar to many people, but this is actually a good way to invest in commodities. And by proxy, you're investing in the oil and gas, the private oil and gas drilling sectors. You get aggressive cash flow returns from this because the majority of mineral rights land trusts, they rent out their land to oil and gas operators, drill, exploration, production, and that lease pays for the owners of that land trust and those mineral rights. And it's a great way to kind of ensure, cash flow and returns, even in a resistant environment, in a recession environment. So this is recession resistant. It has a similar, and because of this reason, it has a similar profile to oil and gas returns, minus the huge tax benefits that you get with a direct oil and gas investment. And so then there's precious metals. This is like physical gold and silver. And this is one of the most popular, tried and true options for purchasing power and wealth preservation. And this is just historically, these are not the same type of investments as we've already mentioned, because they don't generate cash flow, or they don't generate any specific like appreciation like in equity. Many people think of this more as a wealth preservation play, but there are strategies that you can use to leverage or take out debt or loans against the actual metals as collateral, and then invest them in actual real assets. So there's still some strategies to consider, and I'm happy to try to talk about that with anyone offline. Lastly, there's conservation easements. This is like a less well-known option, but it's probably maybe the most powerful strategy for sheltering earned tax income, including W-2. From what I've seen in some minimal research, there's up to 3x to 4x of your invested capital can be deducted off of your W-2 or 1099 tax income. So this is one of the most powerful ways. I know Bio has kind of looked into this a little bit too. What do you say, Bio?
Yes, we just talked about it a few days ago in our local meeting. The issue I have with just my CPA is not a fund because it's highly audited. However, if you can find a very good firm, company that does this and they're able to do it in a very ethical way, you will, it's very, very a good way. So I'm looking for ways to get, to do that too. I've even heard about 5X, but that might be where you're pushing the limit. So basically the strategy here is just to stay in the middle, so you don't want to find people that will be like, we can do 10X. Right. If it's too good to be true, it's probably too good to be true. So don't do it. So I mean, talk to your CPA for sure, but it's definitely an option for sure, because there's only very few options out there.
Right. Yeah. So before we wrap up, there are some additional strategic considerations that are worth mentioning. This is including the ability to invest using tax-deferred vehicles. Since these vehicles can use pre-tax capital and are usually not withdrawn upon the cash flow, it can be really great for appreciation type of investments. You're not worried so much about cash flow. You're not worried about, protecting your W-2. So you can, strategize and get, very intentional about investing for appreciation. Then there's demographic trends that you can consider when making investments, such as migration patterns. The last 2-3 years, we've seen the great migration from the coastal cities and states in Sunbelt states, in the Sunbelt parts of the country. And as we mentioned before, the silver tsunami is already here, and it's getting stronger. So baby boomers retiring means that there's opportunities to invest strategically in retirement, multifamily communities such as senior living and other apartment buildings meant for that age group. And then, of course, there's macroeconomic trends. We can look at like the economic activity based on inflation, based on rising interest rates, central regulation and central planning. We all use these data points, these information to kind of decide where the puck is headed and how we react and what asset classes will do better versus do worse in light of those economic changes. And then there's always energy demand. That's always a big macroeconomic trend. Energy essentially just runs a society. And so keeping an eye on energy demand is a huge macroeconomic, factor that goes into decision-making and strategic investing. So to summarize, the key first step we feel is to identify your why. As we mentioned before, this is based on your fundamental values and your desired reality. It will help next to determine which forms of wealth goals that you set and pursue. And then finally, remember that this is just monetary wealth and it's used as a tool. And through that, you can achieve these wealth goals through the real asset investments in the examples that we listed above. So with that, we should open it up for questions or any final thoughts, Bio, before we open it up for questions.
Yep. So, I mean, very great presentation, and I think, like you said, it's important to find out who you are. You need to have a personal financial statement, like something that guides your investment choices. And also, basically you decide, okay, fine, this year I want to do, 50% stocks, 50% real estate, maybe 5% this. So you have a guide, and there must be a reason why you're doing what you're doing. And after that, then you can break it down into now under real estate, which one am I trying to do? Is cash flow more important? Like for me, I'm at the growth phase of my life. So I go for, cash flow, high return, even if I have to take slightly more risk. versus, some people are like already 50 years old, 55, they're close to retirement. Now it's capital preservation, and they go for A-level properties and things that they're like, okay, 5% return, but it's stable, versus shooting for that 12% return, which more likely to lose your money. So that's essentially it, in investment. So I do know some people here though, that I might, call by name that are doing some things. Raj couldn't make it. Is Richard here? Richard Scott.
I am. Good afternoon, guys.
Yeah. So Richard Scott lives in Northwest Arkansas, and he's one of our partners also, which, is live just close to what I call us. So he probably drive by it every day. But I know you do have some investment back home in Jamaica. You feel like, kind of talk a little bit of like your decision on and how you align your goal with your investment choice.
Absolutely. Thank you, Bayo. So as Bayo alluded to, my name is Richard Scott, and I am not a physician. I always tease and say I wasn't smart enough to be one. However, I've been fortunate enough to operate different aspects of healthcare operations. So I operate a preventive telehealth company that focuses on chronic care management and remote patient monitoring. And then I've also dabbled a bit into high complexity lab, as well as primary care and specialty practices. So I'm born and raised in Jamaica, and rural Jamaica, where coffee farming was kind of a big part of my upbringing. However, the economy there is very cash driven. So I do some farming there, less than 5% of my portfolio, so to speak, is in farming there, and looking to expand in plantains and some other produce. So that's kind of my background. Also do some real estate here. Currently have 12 units and growing, and then the rest of what I do is in healthcare.
Yeah. Okay. Well, thanks, Scott. So we open it up for questions, and if anybody would like to add some things that they do that's exciting.
So we have a question in the chat box. You guys can put questions there. You can also unmute and ask questions. Our first question is from Fasanya. He's asking a really good question. Since your partners are all founders, since we are all founders of our own companies, how do you partner together as GPs to take down deals? And this is something that I learned as I joined different mentoring clubs, just the actual structure of these GP teams. You'll have, especially with the large syndications, you'll have folks who leverage their talents and bring their skill sets to a GP team. And so Bayo mentioned he's an operator. And so this is someone who's actually managing the asset. So this is like operations, right? And so they're doing some underwriting, they're managing personnel, they're managing property managers, they're acquiring and sourcing the deals. And then you have folks who raise capital for deals and do asset managing. So this is kind of the investor relations part. So this is where I have come in as a syndicator, and I bring my relationships with these best-in-class operators and form a GP team, because one of the most important things about these larger deals and the power of syndication is being able to go after these larger deals is to get a group of investors together in strong deals. So that's how these deals can be structured. And then on the other side of that, you have LPs or limited partners who take a more passive role. It's not fully passive. LPs still need to do some level of diligence on those operators. And that's where, the value of these teams come in, where you have someone that, brings best in class operators to LPs. So still it's a little bit of active work, but once you're, have trusted and, vetted a operator or a team, then you can invest, and then it's mailbox money essentially after that. It's cash flow, appreciation, tax relief, things like that. Anything to add on that, Bio?
Yes. So, you know, to take a deal down, you know, it's also another soul searching that we do sometimes. We're like, should we do these $10 million deals, which is just two of us, or should we join this team and do a $25 million deal, or do this $79 million deal? So what happens is usually the return sometimes, or the stability, the type of people that buy these assets, they're usually institutional investors, and sometimes it's better to deal with those people, that will buy it from you at the end. So as a result, sometimes it's better to take a bigger deal. And then if you cannot take it yourself, usually you partner with another team. So as an operator, I can partner with another operator, also, but mostly partner with investor team that focus on raising funds, so investor relations. And, so that's how it usually works. And of course, at the back end, we discuss, there's always that 70, 30, 25, 85 GP LP split. And that is decided on the back end, how you do it. But it's also not a, what can I say? The two heads are better than one, or three heads are better than two kind of a situation. But at the same time, maybe 10 heads is too much. So you have to, kind of watch what kind of partnership you make. And also, don't make partnership lightly.
Right. Yeah, that piggybacking off of that, what you guys might start seeing, especially now, there's like partnerships that are so big, but a month later you see some of those partners with other teams, and so they're just kind of mixing and matching. When there's big teams like that, it's definitely something to keep in mind. You want probably smaller, more familiar teams. And that's why, when I partner with operators, I try to stick to the same small group that I've already invested with. So I've vetted them. I'm invested with Bio's deals, and I'm invested in other deals with other operators who I trust, and I keep that small, So this is kind of how we still work together, but we're not necessarily the same company, right? And you'll see that a lot, and you just want to be careful if too many people are bouncing around with too many other, partnership teams. So any other questions or follow up to that question?
I'm sure some of you are doing some exciting things, foreign deals. Any investment class we didn't mention that you guys have tried?
Cool.
Okay.
This is the first one of the year. We just got one in. Do you guys have a signed contract to work together? So yes, whenever it's by deal, when you have a opportunity, you usually enter into a memorandum of agreement. That's one way. And sometimes you can actually have an actual contract. But from what I understand and what I've seen in the deals that I've co-sponsored, it's a memorandum of agreement when you work with a GP team. So, in deals that, I'm doing with Bio, we'll have a memorandum of agreement.
Yes. So, everything is based on trust, or overall, and the goal is, for us to, we have synergy. So the goal really is to scale together. So we have the same purpose, the same mission and vision. So, so that's what it is, mostly it's based on trust, but also per deals. So when you have a specific deal, because it depends, like for example, I might be able to raise 50% of the deal and he raised 50%. So, that contract is going to be different than another deal where he raised everything and I just operate. So, so it will be different contract every time, different LLC. Every single deal is a new LLC, maybe 3 LLCs, sometimes 5 LLCs for one deal. So, but then, you write each other into the contract.
These are good questions. They go into a lot of like asset structure, asset protection. This is, what Bayo's talking about with all the different LLCs that go creating these teams. There's actually LLCs for the LPs as well. They all invest into a business, which is either a LP or LLC that actually manages the property. So very, very good questions, high level.
We have one more.
How did you go about acquiring the financial knowledge before pursuing investments? So I can answer on my end first. I took a year before I made my first passive investment in anything. My learning style is audiovisual. So I was just diving into content from podcasts, and I can give my recommendations, YouTube videos, audiobooks. And then I started going to meetups and started asking questions for the leaderships of these meetups and from other, members of those communities, just to understand the lingo and get my confidence up for trying to do one of these investments. So I took a year.
Yeah. So I'm before I used to do financial blogging, I blog. So I kind of read lot of books over time. And that kind of helped me kind of get, basic idea. I read a lot of real estate books, a lot of stocks, regular investment books. Also, like George said, I also, watched a lot of videos, webinars. I even went for a few courses. And my wife still make fun of me. We went to Rich Dad Poor Dad class one time. And then after they tried to sell us like a $50,000 private lesson, we finally quit. But we went, we read about it, we met, some of his team. So we actually do that. Also, we have these webinars. Okay, so this webinar, we do it every 2 weeks. By the time it's the end of the year, you listen to like 26 webinars. Even passively, you'll be learning a lot, and then everything we talk about, you can go research about it. And there's Bigger Pockets. Bigger Pockets was one of the most pivotal for my learning for real estate. Join the team, join them. You can ask questions, type into the box. It will be stupid questions oftentimes. Just make sure you search for if there's an answer before you ask some of the questions. But you find a lot of information, and you can also ask us. We're available. We have a WhatsApp group. He has a WhatsApp group. I have a WhatsApp group. Most of the content are overlap, so you might as well join both. And we post whatever, every day we at least have some educational thing that we post, So that's how you usually get, this knowledge. Many of them is going to take you time. And, just make sure you're comfortable before you do anything, in terms of investing.
So I forgot to add, I also, joined a mentoring club. I mentioned it before, but I'll just speak on it a little bit more. I joined a mentoring club based out of Dallas. They're called the Real Estate Guys. They also have a podcast. I listened to their podcast for about 2 years before joining their mentoring club. And through that, there's a lot of educational content in the form of webinars. And they have a website with a lot of educational content. And so I leveraged as well. And the members from that group, which they have a ton of experienced operators across each of these asset classes that we mentioned. And that's where I actually found my current co-GP partner on the 13 unit deal that I'm invested in operating currently. And so it's a leverage of education, like the material, as well as the networks. So it's not for everybody. And for a long time, I didn't think it would be for me, but there was something that kind of aligned when I went to one of their meetings with that group, and they are really, really solid, good operators, and the experience has been really good so far.
Someone asked how they can join the WhatsApp group. Unfortunately, I have it only on my cell, so maybe next time we have it already, in like a link. But I give my cell out. You can type your cell phone too, George.
Yeah.
And then they can message you, and then they can join. They can also join our Facebook group. There's a bunch of them, but I have the Dr. Breathe Easy Capital. You'll be easy to find it. Are you going to have your Facebook group, George?
Eventually. Gotta get on all platforms.
Okay, so I have mine already, Facebook group. Okay.
Well, thank you, guys. So the next webinar, just so you guys know, is January 21st. These are bi-weekly, so 2 weeks from now. That'll be, again, Saturday at 4 p.m. Central Standard Time. We're going to have my co-GP, where I'm invested with in the deal, on the 13-unit deal, Shannon Robnet. He's going to be talking about real estate developments, the pros and cons of large multifamily development. And then we'll have another webinar on February 4th. We're still acquiring or looking to get our speaker. It's likely going to be a CPA who talks about tax strategy, since it's the beginning of the year. And that's a huge thing for, investing and financial literacy and health and well-being. So we'll likely have a tax strategist.
Yep. Thanks, George. There's one more question. We can just answer that and then we'll wrap up.
I've done a lot of real estate. I want to make real estate investments a big part of my investment portfolio. I want to purchase 12 to 20 unit apartment complex. Can you give me pointers if needed? Absolutely. Bio definitely can have some input on this. So for sure, that's Fasanya. I'll definitely link you guys.
Yeah, I mean, we can talk more one-on-one, but most important part of this is finding the deal. They say once you find the deal, everything takes care of itself, right? Even finding people to invest with you and everything else. If the deal looks good, nobody can deny that. So you need to find a way to find off-market deals. And we actually have a webinar, our first one, which talks about how to source deal in this market. It's on our YouTube. I'm gonna just text me. My cell phone is in the chat, and I'll send you the link. So it talks about how to find the property. If you cannot, then you should get a commercial real estate agent. That would help you find these deals. But oftentimes, though, when the deal is on the market, if you find the deal on Zillow or Craigslist, it's already too late, because that means they've sent the deal to me and many operators. So think about 8 professionals or 10 looking at a deal, decided that this deal is not a good deal, and then they post it on the markets, and then you buy it. Yes, in real estate, if you stay in it long enough, you will eventually be profitable. That's true. But how long? So, so the deal will be like you're starting from you're climbing a hill to be profitable. However, there are some people that I've seen that have specialized skill in which they're able to see things that other people cannot see. But I would not consider myself to be better than many of the professionals. So basically find, a commercial real estate agents, try to see if they'll, get you some, smaller off-market deals. Also, you yourself, look for the list of every single multifamily in the area. And if you see that the grass is overgrown, and it's a little bit not well kept, find who's the owner, find who owns it and call. Do you want to sell? That's usually what it is, but we do it in a systematic way. We send people out to do knock doors and try to find these deals. But if you have time, you can do this on your own, drive for dollars, just drive around, find a house that is kind of breaking down and and then call who owns it and see if there are actually absentee owners. Absentee owners are always a good one. You'd be like, oh, where do you live? In California. Well, your property is being run down over here. I'd like to take it off your hand. And how much do you think? So, yeah, so that's what I have on that topic. But, message me and we do, I'll help you as much as I can.
Awesome. Well, thank you all for attending tonight. We hope everyone has a great rest of their weekend, and we look forward to seeing you on the next webinar in 2 weeks.
Okay. Thanks, everyone.
Thanks, guys.